Abercrombie surging 17% after beating on the top and bottom lines for the first quarter, even expecting a $50 million tariff expense. Despite the better than expected sales, my next guest has turned more bearish on A&F lately, if I can call it that. Let's bring in Stacey Widlitz, president at SW Retail Advisors. Stacey, this is one of those reports. You look at the stock, it's down 50% from the highs last year. Abercrombie is down 35% year to date. Kind of gives you some context around the pop we're seeing today.
Absolutely. And Kelly, what you saw today is a continuation of the deterioration in the Abercrombie brand. And remember, a year ago, that was the sweetheart brand that was growing at such a pace. And now it's flip-flop. Now we've got Hollister growing in the 20s and Abercrombie comping down 10 here. So, we saw those promotions flip on in January. And that's when we put a negative rating on the stock. We upgraded it about a month ago. The bad news seemed to be in there. But, going forward, I think you really need to get both of these brands on track in order for this stock to move to the next level. It kind of reminds me of Urban Outfitters, where you've got the Urban brand and Anthro finally both moving together. And that's when these stocks really get a different level of valuation.
Yeah, I think a lot of us have just caught up to the Abercrombie trend. The 90s are back and Gap and the denim is back and athleisure's out. And that was the whole narrative last year. So also 2 weeks ago, we saw American Eagle with that. I think they withdrew guidance. They had a huge inventory write down. That wasn't even a tariff story. It was just a fashion mess.
Exactly, Kelly. And you're seeing, obviously a lot of names, including Macy's, are saying, hey, there's, tariffs, let's bring tariffs. But there's also names, including Macy's and AEO that you talked about, that are having to be more promotional because they didn't move product from early spring and last winter. So that's a whole other situation. There's the tariff blame game, and then there's just your core business not doing well and decelerating. Certainly today we heard from Dick's, comps up 4% on top of a 5. No issues there. My issue with that stock is obviously the Foot Locker acquisition, which,
right.
Certainly why would you want 65% exposure to Nike when they're starting to sell on Amazon?
Right. No, and I think the deal was announced just before we got that news, by the way, which is an excellent point. But the reason I'm asking about some of the tactical issues here is to try to figure out what is the message. Like if you're sitting in the Oval Office today or you're advising the president or what have you, what is the takeaway from what we've heard from the retailers? Is all fine? The stocks are in the green, even as they're announcing tariff hits and so forth. Or is it just that the market had already priced in much worse outcomes that may still be coming, but there's a bit of a relief rally today?
I think that's exactly it, Kelly. It's like we've been hearing about what is the worst case scenario. We've just been every morning you wake up to different headlines. And at the moment, it's like, OK, it's not that bad. There's a 10% guide down for tariffs. It's really not that bad. But I think the bigger issue is that what you're hearing from some of the companies like Macy's is, well, you know what? We're going to raise prices, or the consumer is just going to have less choice because we're not going to bring in stuff that we can't make money on. So the other thing is that they're pushing back on vendors. There's going to be cancellations. So some of these national brands are going to be left with stock with extra inventory. And of course, TJX is going to be doing a happy dance as usual when all this stock is left over.